Now, having outlined some of the prevalent financial risks that business entities may encounter in their financial activities, let's talk about some of the countermeasures they ought to consider taking in order to mitigate them. Shall we? So the first risk we spoke about was the risk faced by creditors due to the default of their debtors. Now, of the many measures that creditors could take to mitigate the detrimental effects of credit risk, here are three viable ones. Firstly, adopting good credit rating systems. These essentially help financiers ascertain the creditworthiness of a borrower. In other words, the likelihood of them repaying the debts without defaulting. Now, a debtor's creditworthiness or credit score is based on a number of factors, including whether or not they have any current outstanding debts and their payment history in terms of how early or late they pay their bills and other debts. So by having effective credit rating systems in place, creditors would be able to gauge the likelihood of their debts going bad and accordingly avoid it. Another mitigating measure would be for creditors to better manage their cash flows. How so? Well, by way of financing different types of borrowers, venturing into different markets, and exploring a variety of products. This is what is known as diversification. By diversifying, financiers would be able to set off the negative effects caused by defaulting debtors, declining markets, and non-performing products with those that are doing the opposite, i.e. those that are doing well and have a positive effect. Now, aside from diversification, financiers may use securities as a tool to mitigate credit risk. This is through demanding third-party guarantees or taking mortgage from borrowers. So, for example, if an Islamic financial institution intends to enter into a murabaha contract with a customer, a markup sale, the Islamic financial institution may stipulate that if the customer defaults, then it would be entitled to regain possession of the mortgaged asset, sell it, and reclaim from it its costs. So good credit rating systems, diversification, and securities or guarantees are three highly effective tools to mitigate credit risk. Now, aside from credit risk, we mentioned that certain risks occur beyond the control or independent of the decisions of market players. To counter such risks, referred to as market risks, business entities may once again resort to diversification. By diversifying, whether in the form of investing in various sectors at once or at least sectors outside of one's own, business entities would stand a fighting chance against inevitable market forces. Practically speaking, when the economy is hit as a whole, the impact of such hit would differ from one sector to another. As such, it is important for market players to conduct advanced technical market analyses and strategize accordingly. Part of it would be to ensure that their portfolios comprise of investments that have a negative correlation with one another. For further elaboration, looking back at COVID-19, we saw that sectors like the automobile and airline industries recorded a great deal of loss during the pandemic, whilst the pharmaceutical industry, for obvious reasons, recorded huge gains during the same period. Hence, by effectively diversifying, market players would be able to set off the impact of a sector that is witnessing a decline with another that is witnessing growth, and ultimately shield themselves from both kinds of market risks. Now, in addition to diversification, another tool that business entities may consider using to mitigate industry-specific risks is forward contracts. They are commonly used in the agricultural sector, where entities intending to buy agricultural goods pay for the price of the goods today, upfront, for it to be delivered at a future date. Now, in the context of Islamic finance, this arrangement is known as a bay' as-salam, or an advance payment contract. And the advance payment feature serves two main purposes. One, to assist farmers in acquiring or raising the seed fund that they need to begin farming activities. And two, to protect buyers from potential price volatility. Now, if you've noticed, diversification has thus far appeared on the list of mitigating tools for more than one financial risk. Spoiler alert, it appears on the list yet again for operational and liquidity risk. Why is that so? Well, simply because it is a clear indication that a business entity is strategizing well. That instead of putting all their eggs in one basket, they're allocating their limited resources with maximum expertise and efficiency, particularly as it relates to cross-border transactions involving more than one jurisdiction or legal system, which could be quite tricky to maneuver. And speaking of compliance, how can we not talk about the Sharia? As we would know, within the Islamic finance industry, there are numerous bodies offering Sharia advisory services, some in specific areas, while others broader in scope. Now, notwithstanding their vigorous efforts, it is important for market players to assess the weight of the advisory services or the Sharia certifications that they intend to rely on. This is critical because Sharia rulings are not standardized across the industry, meaning different states apply different sets of Islamic principles. So even in instances when internationally recognized and respected bodies like the OIC's Fiqh Academy, the Accounting and Auditing Organization for Islamic Financial Institutions, known as IOFI, and the Islamic Financial Services Board, or the IFSB, that serve as the guiding voices within the Islamic finance industry, even when they set standards and issue guidelines, it is important for market players to reach out to Adl Advisory, the relevant experts, trained and certified Sharia advisors or advisory firms within their respective localities, lest they be exposed to Sharia risk. In conclusion, it is incumbent upon market players to take active steps like enhancing the technicalities within their business operations and seeking the advice of relevant experts in order to mitigate financial risks. Doing so would ensure that they are better prepared and positioned to tackle the respective risks, or in some cases, prevent them from happening altogether, to taking calculated risks and beyond. Assalamu alaikum wa rahmatullahi wa barakatuh.